Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil.
Paris rapeseed. 16 weeks ago, that's right, 16 weeks ago, I detailed some key bearish pressures that the market had started dealing with. They were, and I quote, "We have overhead a more diaphanous congestion band between 456.75 to 468.75, a band that was relatively easier to navigate than the others mentioned, but which now has three key potential bearish pressures within it. They are the declining short-medium moving average, currently at 424.75. Remember that one, that's going to show up again later. Then the medium moving average, currently 432.5, and the declining long moving average, currently 446.75. At least two out of these three are descending to impact the market, and one should not take away anything from them, especially any efforts to pressure the market from above." End of quote. The short-medium moving average, the green one, ended up being the key bearish pressure here. It had been impacting the market since early November 2023, and the build-up of bearish pressure and the erosion of the bullish incentive eventually saw an initial break below a key congestion band between 438 to 445.75. And that was in late December last year, and a further proper break blower at the start of January this year. Now, the move lower was not without incident, as the old lows from October 2023 in the 420 zone caused prices to revert back up in mid-January, up to the overhead congestion area. However, once up there, the market made a horn top in late January, and we've moved 3 steps down and 1 step up until the last few weeks, making new lows and low closes, not seen in some cases since June 2023. This now brings into focus some potential pattern targets I laid out some 18 weeks ago, plus some cautionary potential supports below. Thus, and I quote, "For the head and shoulders top pattern," so this is the June to September 2023 head and shoulders top pattern, "for the head and shoulders top pattern, hence a primary target would be in the 400 even zone, for secondary harder to reach target X1 in the 354 zone. Any move lower towards these would be very, very interesting, as we have alternate neckline 1, currently at 402.75, and alternate neckline 2, currently at 406.75, both in the way, and both originating back from the old November 2019 to February 2020 head and shoulders top. They are highlighted in bright red and green, respectively. Additionally, there is the November 2020 low at 396.75, which is also in the way on any move lower. I would further note that these three supports stopped the fall of this market back in May this year." End of quote. So by May this year, I of course mean May 2023. One final key point, and that is 5 weeks ago I drew a small end of November 2023 to mid-January 2024 bearish shift pitch to help show the bearish angle of attack of this market. The market had been very carefully following this pitchfork lower, showing as it does the bearish angle of attack. I have highlighted this pitchfork in dark blue on my daily chart. Now, I said the following last week, and I quote, "However, the next week and a bit should be interesting, as the middle time crosses down through the first of the rising alternate necklines, and I would suspect we may see something give way at that point." I also note how the short-medium moving average is religiously tracking along the upper time, currently at 422.75, of this same bearish shift pitchfork, providing additional reinforcement if it was needed. And the declining medium moving average, currently 432.5, is not that far away either. End of quote. This was all well and good last week, but this week we have seen a turn towards the bullish, with a move up and test of not only the upper time but the green short medium moving average that is supposedly reinforcing him. This is not a major turn, not yet, but it is not far away from being one. If we do turn higher, properly if we do turn higher, then the first key level is not far away at the February high at 427 even. Well, we could see significant recovery higher and proof yet again that the two alternate necklines still have what it takes to turn prices higher. Now, the reason I said 427 is that any move over that level would set up the opportunity for a possible double bottom over mid-January to date period. So watch what happens at the green short medium moving average, 427 level and the medium moving average overhead. Winnipeg Canola. What I consider to be the most important recent pattern here is the late August to mid-November 2023 bearish shift pitchfork, highlighted in dark blue on my daily chart. You can also throw in here some past patterns such as the short medium moving average. It's currently at 617.20, which is highlighted in green on my daily chart, as well as the combination of the October to November reverse head and shoulders continuation pattern. There was also an ascending triangle. This was not the best looking version of such a pattern, but it nevertheless still worked at the time. Okay, so 11 weeks ago I said the following, and I quote, "My concern with this move lower was this could be seen as a precursor for a move down in the other oil seeds and veg oils. My thinking was that such a move could be seen as the market seemingly choosing to try and form a bearish halfway hesitation over November with potential all the way down to the 580 zone. This is not a done deal, and I have not placed any targets below, but is worth considering in the coming days and weeks." End of quote. The target for this bearish pattern, well, that was reached 3 weeks ago. Moving back down to the dark blue bearish shift pitchfork. This has been excellent in showing the bearish angle of attack of this market since its inception. In November last year, really only until this week, that's been really good at showing it until this week. Specifically, as in the past, been the upper time currently at 590.90, acting as a dynamic downtrend, and the upper bear channel line and the middle time. So been the upper time has been also as a downtrend, and then the middle time currently at 553.5, acting as a lower bear channel line, and the middle time that has been superb at showing the way lower. So what had we in the way lower that slowed, halted, and eventually turned prices higher? Well, looking at it, not much. It seems the approach to the December 2020 low at 567 even was the thing that finally turned prices higher. Or more specifically, the approach of the middle time support towards the other support this week. This week we've been breached, not broken yet, but breached. The upper timers, we've only had one close over the upper time. So what have we in the way topside? Well, there is the May 2023 low at 611.10, which was good enough to support the market in January, and then we have the 2021 low at 629.60. But I would closely look at the previously mentioned descending short medium moving average in green as being a significant dynamic resistance, moving down each day as it is. Beyond that, perhaps the parallel medium moving average, which is also currently at 652.10, but that's still quite a way higher. Finally, I would once again add the following as a postscript to what I have already said, something I first said 10 weeks ago, and I quote, "I would add this final thought. I'm increasingly becoming interested in knowing if this contract is really an indicator, a leader, if you will, of what the other oil seeds and veg oils may have to deal with." End of quote. To this I added last week, and I quote, "This also means on any recovery and move back up, and not only on the way down." End of quote. Bursa Malaysia crude palm oil. If you listen to any of my commentaries here on palm oil, you would have heard me repeat so many times that the mid-August to early November 2022, that's right, August to November 2022, well over a year old, mildly bearish shift pitchfork, the one highlighted in dark blue on my daily chart, was running the show here after and over so much time. This mildly bearish pitchfork guided prices more or less lower, initially in between the upper time, which is currently at 39.36, and the middle time, currently below at 33.04. Then for a while in May and June last year, between the middle time and the lower time, currently at 26.72, before prices moved back up again to test the upper time in January this year, and then February, and now March. In January and mid-February, we saw the upper time breached, but then only for single close each time over the upper time. Not so last week. Last week we had multiple closes over the upper time, and this week the move higher had exploited that breach, turning it into a proper break higher and the imminent end of this venerable bearish shift pitchfork. Now, going back a few steps, first, the significant patterns and levels at one time or another within this bearish pitchfork had been the June to September 2023 diamond pattern, the bright red uptrend currently at 37.69, dating from late May 2023, which I still think is a very valid one. The interesting 61.8% Fibonacci line at 35.92 of the late May to late July 2023 move, the purple neckline of the September to November 2023 reverse head and shoulder pattern that's currently at 39.96, and the February 2011 high at 39.53. Now, at one time or other, these have acted as a support or a resistance, or now resistances that have become supports, which in turn have helped to drive prices higher, rising through the previously mentioned upper time in dark blue, and thus making a strategic change in the overall longer-term bearish perception of this market. I did say 5 weeks ago here, and I quote, overall I would suggest watching what the market does at either the blue upper time or the red uptrend, and the lesser Fibonacci line at 35.92 to gauge any clues as to what may be next. I suspect with the uptrend and the upper time converging, it may not be that long, end of quote. Indeed, we didn't have to wait that long, as we've punched up through the upper time and the purple neckline and up to the resistance of the July 2023 high of 41.89. Now, there could be an argument put forward that the action as far back as even September last year is a possible, if broken and repaired, bull channel, with the breached and repaired red uptrend as the lower bull channel line and the now broken purple neckline as the upper bull channel line. Now, I can see the attraction of such an idea, but I didn't go with it back 5 weeks ago, and I still really don't go with it now. However, I could see the attraction of such a pattern, and so I've placed at target X at 42.40 as the potential target for such a pattern. To reach this potential, the market would have to not only overcome the July 2023 high, but also the neckline currently at 42.07 of the old but large September 2015 to November 2017 head and shoulders top, as well as congestion at 42.39. Looking at the market and its actions, these seem doable. They do seem doable, given the ammunition we have seen accumulated below since August of last year.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.